In fact, I think what they did was made it sound scary and then give us a watered down version, so actually it wasn't too bad. Negative gearing, capital gains, and tax on trusts. This has been billed as one of the biggest tax changes for decades. But what does it actually mean? Honestly, it sounds like the government's doing a wonderful job at trying to even the playing field and punish investors so that more owner-occupiers can get in and buy property. And in theory, I don't disagree with their sentiment and trying to do that. I think it's wonderful. I think negative gearing was stupid. I never understood it at all. Nowhere else in the world do they allow you to do it. If you're not sure what that is, let me explain very quickly. If you've got a property with other costs taken into account, which gives you $20,000 in rent, but your mortgage interest is $30,000, then the government said you could negatively gear. You could get that $10,000 loss back from your day job. And that means if you've got two people earning $100,000 a year, one buys an investment property losing 10 grand a year, they're only taxed on 90 grand. The other person earning $100,000 and not investing in property gets taxed on $100,000. So two people doing the same job paying different amounts of tax. Makes no sense, never made any sense, but under the current rules, that person got a tax rebate. That's been scrapped. There's lots of good reasons why you might go, oh, but we're supplying housing stock. Bullshit argument. They haven't gotten rid of it if you buy brand new properties. If you buy brand new properties, you are supplying more stock to that housing market. And if you're buying an established property, you're not supplying new housing stock to the market. So why do you get to get some of your earned income tax back? That 10 grand loss under the new system, by the way, now would be carried forward to future property losses. So it's not completely disappeared. It just means it takes time to get it back. But this is such a watered down version of what has happened in other countries. The UK and New Zealand scrapped tax deductibility altogether. And so under their system, if you made 20 grand rent, that would get taxed. And so you'd pay somewhere between $6,000 and $9,000 in tax, and you'd still have your 30 grand interest bill to pay. So they didn't do that in Australia. They've kept negative gearing for brand new properties, and they still allow you to carry forward the losses. So it's a very watered down version of what they could have done. And that means as an investor, not really going to make a huge amount of difference to me and most of my clients, but it will make a difference to some investors, and I get that. It will reduce borrowing capacity for investors in the short term. Capital gains, on the other hand, again, it's like, oh, it's a big change. You used to get a 50% discount. Now you're not going to get a 50% discount. There's at least 30% tax to be paid. But they've just gone back to the way that the tax was done in the 80s, which is that they adjust your cost base for inflation. And that means over the long run, if a property goes from $1 million to $3 million over, say, a 25-year period, well, under the current rules, that's a $2 million gain, but you get a 50% discount and pay tax on $1 million. That $1 million gets added to your income or yours and your partner's income, and you pay tax on that. That's under the previous system. The new rules, however, say you bought a property for $1 million, but inflation means that $1 million is now more like $2 million in 25 years' time. And so that $2 million is now your cost base. The property's actually worth $3 million, so you've made a gain of $1 million, and so you have to pay tax on $1 million, which is almost exactly the same as the 50% discount system. So depending on how fast the markets grow relative to inflation, you're either going to be better off or worse off versus the other system. The 30% minimum is just a kind of a catch-all so that you can't just kind of hold property into retirement and then sell the property, make the capital gain when it's your only source of income. Make the gain when it's your only source of income, and therefore maybe pay lower rates of tax because they've said it's a 30% minimum that you're going to pay. So there is a risk for some people that made relatively modest gains, split between a couple of people leading up to retirement, that they can't necessarily get as much of a discount as they would have done. But the difference is very, very small. When it comes for family trusts, there's actually bigger impact there because they've now implemented a minimum 30% tax rate. And that means you can't distribute gains to adult children that are at uni and that are not using their $18,200 tax-free threshold, that are not using the next $27,000 worth of tax at 14%. You can't just use them and get the tax rate down. You've got to pay a minimum 30%. And likewise, carrying property through into retirement when it becomes your only source of income, that's going to be a problem for me. I just need to rethink my retirement strategy based on those changes. But by and large, as a professional investor, as someone who advises on investment property, these changes are not a big deal. Could have been much, much worse. In fact, I think what they did was made it sound scary and then give us a watered down version. So actually it wasn't too bad. So if you're losing your minds over it, please calm down, relax, look at some real numbers, talk to your accountant, talk to your broker, find out what the real impact is, and you'll probably find it's not that huge. Try and make intelligent decisions going forward. Does that make sense?